Okay, so we've got a real head scratcher on our hands today. Accel Entertainment just came out with a record-breaking quarter, but Wall Street's reaction? A whole lot of nothing. It's a classic puzzle, so what gives? That's exactly what we're going to dig into. All right, here's how we're going to break it all down. First, we'll look at the paradox of those headline numbers. Then we're going to pop the hood and see what's really driving their growth. After that, we'll check out their big plans for the future. And finally, the part you're probably waiting for, our call on where we think this stock is headed. So let's jump right into that paradox, because it's kind of like the company was saying two different things at once. On one hand, they delivered a really solid beat on profit, but on the other, they just barely missed on revenue. And this, right here, is the heart of the matter. It's a classic beat and miss. Accel proved they've got a great handle on profitability, which is awesome, but falling even a little bit short on sales gave the market pause. This really set the tone for that lukewarm reaction. Now, when it comes to profits, yeah, they absolutely crushed it. Adjusted earnings per share came in at 26 cents. Wall Street was only looking for 22 cents. That's a healthy 14% beat. No question about it, a strong showing on the bottom line. But, and this is a big but, the revenue side wasn't quite as rosy. They landed at $335.9 million, which was just a smidge, about 0.5% below what everyone was expecting. Now, 0.5% doesn't sound like a lot, right? But in this market, it was enough to make people tap the brakes. And if you dig a little deeper, here's what you find. Even with that tiny miss, they still pulled in record quarterly revenue and record adjusted EBITDA. Both are up nicely from last year. Now, you're probably looking at that net income number and thinking, whoa, down 50%? But hold on, that's mostly just accounting noise from a non-cash adjustment on an old deal. The actual core business engine, it's humming along just fine. So, okay, what's actually powering that engine? Let's get under the hood and look at their actual strategy. It really boils down to two things: expand their footprint into new areas and increase the density of machines in the markets they're already in. And you can really see this strategy playing out when you look state by state. Their main market, Illinois, solid, steady growth, up almost 9%. Then you look at the newer spots, like Georgia and Nebraska. I mean, wow, that's explosive growth. And yeah, Nevada's down, which looks bad on the surface, but it turns out that was just a one-time thing where they lost a single big customer, not a sign that the whole market is falling apart. One of the big moves they're making, especially in Illinois, is rolling out this TITO technology. If you've ever been to a modern casino, you've used this. You cash out, get a paper ticket with a barcode, and then you can stick that same ticket into another machine to play. It's a huge quality of life upgrade for players, and for Accel, it's a massive win on the operational side. Way less cash to handle. Okay, so that's what's working now, but what about the future? Where are they putting their money to keep this growth train rolling? Well, it's all about some big investments and smart acquisitions. And honestly, management's game plan here is refreshingly simple and clear, which is always good to see. They're trying to squeeze every last drop of profit out of their main markets, while at the same time ramping up the newer ones. Add in getting their latest acquisitions humming along and always being on the lookout for the next smart deal, it's a solid, disciplined approach. And there are really two big projects you need to watch. First, the Toucan Gaming deal in Louisiana. That's already kicking in about $10 million a quarter in revenue. Nice! But the real big swing, the main event, is the new Fairmount Park Casino. Phase 1 is open, but we're not going to see the big payoff from that, the real dollars hitting the bottom line, until probably 2026. And this quote from their president of U.S. Gaming really just nails their whole philosophy on buying other companies. See, they're not out there trying to land a whale. They're all about what he calls bite-sized acquisitions. Think smaller, smarter deals in the local gaming market that they can easily digest without taking on a ton of debt. In a market like this, that kind of discipline is a real advantage. So this all brings us right back to where we started. You've got record EBITDA, a clear plan for growth, and a smart, disciplined strategy. So why? Why did Wall Street basically just shrug its shoulders? I mean, look at this. After the numbers came out, the stock did pretty much nothing. It closed the after-hours session up a measly 3 cents. For a record quarter, that's just, well, it's not the reaction you'd expect at all. And here's why. The market is basically saying, okay, that's a nice story, but show me the money. It's a classic show me situation. Investors hear the plan, but they're waiting for cold, hard proof. They want to see that Fairmount Park is actually going to be as profitable as they say. They want to see the Louisiana deal really boost the bottom line. And they need to see that all this spending is going to lead to real long-term growth. All right, so with all that in mind, let's get to our final take. This is the next call, where we'll tell you what we think happens from here and give the stock our official rating. So looking ahead to next quarter, we're expecting revenue to be pretty solid. It should meet, maybe even slightly beat expectations as they get those new Louisiana assets fully up to speed. But the stock price, we think it's going to be stuck in neutral for a while. The big game changer, Fairmount Park, is still several quarters away. And until that picture gets clearer in early 2026, there's just not a compelling reason for the stock to make a major move. And because of that, we're kicking off our coverage with a market perform rating. Look, this is a well-run company doing all the right things. But the big catalysts, the stuff that could really make this stock a huge winner, they're just not happening tomorrow. They're on the horizon. Now, if you're looking for a way to play this, here's an idea. You could think about a pair trade. You'd go long on Accel, betting on their steady business, their resilient local focus, and the fact they buy back their own stock. But at the same time, you'd short a broad gaming ETF, something like BJK. The idea here is to isolate Accel's own performance from the bigger picture, hedging against the risk that consumer spending slows down and hits the whole sector. At the end of the day, this whole story really boils down to one word: patience. Accel is playing the long game. They're spending money today on projects they believe will become cash-printing machines down the road. So the big question for any investor looking at this stock is pretty simple. How long are you willing to wait for that jackpot to pay out? And as always, just a quick reminder, this is not financial advice.